Hi, I'm Kerry Craig, Global Market Strategist. In this video, I'll be sharing our views on the fixed income market. Given the increased recession risk, we expect fixed income to generate better risk-adjusted returns in equities. And while bond markets have been more volatile this year than many investors would have liked, we expect that volatility to subside as growth rather than inflation becomes the driver of bond yields. This creates a more favourable backdrop for core government bonds. Compared to the start of the year, bond yields have risen across the fixed income market, and this implies increased returns from income component of the bond market and a better starting valuation. Meanwhile, core government bond yields have risen into the end of the third quarter, but we do think there is limited further room for them to rise, helping to reduce the downside risk to bond prices. The increased risk of a recession as interest rates rise means we maintain our preference for investment-grade bonds over high-yield debt in the near term. And while spreads on corporate bonds remain relatively tight given the economic backdrop, those spreads may widen in the near term. However, the impact is greater on high yield and the lower quality end of the credit spectrum. For investors with a longer investment horizon and are less sensitive to bond price volatility, the yield from high yield bonds is hard to look past. The structural fundamentals of high yield corporate bonds are entering this period of a possible recession in relatively decent shape. The maturity profile for the next 2 to 3 years is undemanding, and companies have better leverage ratios. While this may not prevent defaults, it certainly can mitigate how far they may rise. In summary, fixed income strikes a relatively better risk-reward balance when the strength of the economy is in doubt. Choosing between high-grade or high-yield debt may depend on the sensitivity to near-term price fluctuations. Thanks for watching.